Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. The core story here is, it's pretty simple, really. It's about critical minerals and supply chain security.
Right.
This company operates the Mountain Pass mine, which is the only active rare earth mining and processing facility in the United States.
The only one. That's a huge competitive advantage right out of the gate.
It's a monumental advantage.
Okay, so let's unpack this. When we talk about a competitive moat, how sticky is that advantage, really? Are we actually talking about a U.S.-backed monopoly here?
It's almost policy-driven. I mean, they provide a China-independent supply chain for materials like neodymium praseodymium or NBPR.
Which are vital for, well, everything.
Yeah.
EVs, defense, renewables.
Exactly. And this is all reinforced by these long-term agreements with, absolute heavy hitters. You're talking about the U.S. Department of Defense.
And even Apple, which is working on recycled magnet production with them.
So these deals create incredibly high switching costs for customers.
They do. It really de-risks the whole operation.
That makes perfect sense, especially, with the whole global focus on reshoring critical manufacturing. But looking at the financials, it sounds like they are paying the price for this expansion right now.
They are.
What's the short-term pain versus the long-term gain here?
That's where it gets really interesting. So right now, the trailing 12-month earnings per share is negative. It's negative 66 cents.
Oof.
And their costs have they've soared. Cost of sales went from, 37% of revenues in 2023 all the way up to 94% in 2024.
94%, wow.
And this is purely due to massive capital expenditure in their downstream expansion.
Yeah.
At the Mountain Pass and Independence facilities.
So they're spending a ton of money to move from just mining the raw material to actually producing separated rare earth oxides and the NdPr metal itself. That's a huge step up the value chain. A huge step.
So what's the timeline for that investment to pay off? When do they see the light at the end of the tunnel?
Well, the market is banking on a very, very near-term inflection point. The company anticipates a return to profitability in the fourth quarter of 2025.
Okay, so just around the corner.
Pretty much. Estimates suggest 10 cents EPS for that quarter, which is a big bounce back from a loss the year before. And for the full year 2026, consensus EPS is up sharply to 69 cents.
So what's the immediate driver for that Q4 shift? Is it just the production finally ramping up?
That's a huge part of it, but it's also something more crucial. Starting October 1, 2025, a key agreement kicks in. It's the U.S. Department of War's Price Protection Agreement.
Oh, okay. The government backstop.
Exactly. This is expected to stabilize cash flows and, combined with higher NdPr volumes, it should push them right back into the green.
That brings stability. Okay, let's talk about the balance sheet for a second. How are they financing all this expansion? Are they just taking on massive debt?
Surprisingly, no. Their financial health actually appears quite strong. The debt-to-equity ratio is low at 43.0%.
That's very manageable.
It is. And their liquidity is excellent. We're talking a current ratio of 8.05 and a quick ratio of 7.51.
So they have the cash to weather this storm.
They do. They are reinvesting heavily, which is why, we aren't seeing any dividends or buybacks, but the capital structure itself is robust.
Okay, so this is where it gets really interesting on the momentum front. The stock price has been on fire. It's up over 260% year to date.
Dramatically outperforming.
Just crushing the entire metals and mining industry. So what does the technical picture tell us?
That kind of movement suggests strong accumulation. The stock is trading well above both its 50-day and 200-day moving averages, which, just signals a classic bullish momentum play.
And the analysts are confirming this.
Oh, absolutely. We're seeing firms like Morgan Stanley, Goldman Sachs, and Daiwa all raising their targets. They're pointing to a potential, 30% to 36% upside from here.
So who is buying? It has to be the institutions, right?
It is. We're seeing declining short interest. It's currently around 14.5% of the float, and that supports the idea of a bullish flow.
The shorts are giving up.
They're throwing in the towel. And we're also seeing institutional accumulation. For example, Financial Enhancement Group initiated a multi-million-dollar stake recently.
We have to look at the risk assessment here. The valuation looks incredibly stretched compared to the industry average.
Absolutely. This is the primary bear case, and you can't ignore it. The valuation is trading at a significant premium. The forward price to sales multiple is 24.69x.
24 times sales.
Yeah. Compare that to the industry average of just 1.44x.
So this valuation premium means any execution delay, any piece of bad news, is going to bring some serious volatility.
It will. And the stock is already volatile. It has a beta of 1.69.
Okay, so what kind of execution delays should we be watching out for? What's the biggest risk?
The key risk is delays in that downstream ramp up. If those elevated costs persist beyond 2025, that Q4 profitability inflection gets pushed back
Then the market would punish that.
severely. Also, global pricing risk remains a thing. I mean, while U.S. policy helps, a surge in oversupply from China could still erode pricing globally.
Right.
And we also have to note the insider selling. There have been significant sales from the CEO and the CFO, which, well, it can raise eyebrows.
Yeah, that's never a great look.
It's not.
So what does this all mean? Can you sort of summarize the investment thesis for the listener here?
Okay, so the company is the established U.S. rare earth leader. It's strategically de-risked by these contracted revenues, the DoD and Apple deals, which are leading to that anticipated Q4 2025 profitability inflection.
Mm-hmm.
It's a core long-term investment tied directly to U.S. supply chain reshoring and defense spending. And it's supported by strong momentum despite, that premium valuation.
So the near-term focus is on what? The Q4 earnings?
Yeah, the Q4 earnings early next February, and any updates on the permanent magnet production start, which is planned for the end of this year.
This company really stands at the intersection of national security and the clean energy transition. So the key takeaway for you is monitoring the execution milestones in the next 12 months, especially that magnet production start.
Exactly. If they hit those targets, the premium valuation might start looking justified by the earnings growth.
And this raises a really important question, doesn't it? If global demand for EVs and renewables accelerates even beyond current expectations, how quickly can the U.S. ramp up its own critical mineral supply to meet that demand without relying on traditional sources?
It's a huge question. The success of this one company is almost a litmus test for that entire national strategy. It's something to mull over.
Absolutely. Thank you for joining us for this analysis. Make sure you subscribe to Investing Talk podcast so you don't miss our next market breakdown.